Budgeting. What is the budget? Budget is a summary of anticipations for what an organization wants to accomplish during a particular period, commonly 1 year. Budgeting framework includes estimations of costs and revenues, expectations for cash flows, expectation for debt reduction. Budgeting establishes a standard for businesses to compare it with their actual outcome and determine how it varies from the forecasted performance. Besides, budgets can be linked with the strategic plans and objectives of the business, since it's an essential part of the development of plans that comes after defining the strategic objectives of the business and exploring the ways to meet these goals. The budget as short-term business plan should define precise targets concerning cash receipts and payments, sales volume and revenues with a breakdown of amounts and prices for each product or service, inventories requirements, labor requirements, production requirements. Financial forecasting can be utilized to decide how companies should assign their budgets for a future period. Budgets are plans rather than forecasts. Limiting factors such as production shortage in labor, materials, etc. might make revising the sales budget necessary to match the production limitation. Large business will formulate more than one budget for a certain period. Each of these budgets will be related to a particular side of its operation.
Types of budgets. Master budget, cash budget. It's a collection of the company's individual budget, aimed to show a complete picture of its financial activity and health. The master budget includes sales, operating expenses, assets, and income streams to allow companies to establish goals and assess their overall performance, as well as the individual cost centers within the organization. The contents of each operating budget will be determined in master budgets. Master budgets used in large companies to keep all individual managers aligned. Operating budget. An operating budget is a prediction of an analysis of expected income and expenses over a specific period. Operating budgets must consider sales, productions, labor costs, material costs, overhead, manufacturing costs, and administrative expenses. Managers might compare these reports month after month to see if a company is overspending on supplies. Cash flow budget. A cash flow budget is predicting how and when cash comes in and flows out of a business with a specific period. Cash flow budget is useful in helping a company determine whether it is managing its cash wisely. Cash flow budgets consider accounts payable and accounts receivable to evaluate whether a company has sufficient cash on hand to continue operating, how cash is used productively, and the probability of generating cash shortly. Financial budget. A financial budget determines the company's strategy to manage its assets, cash flow, income, and expenses. A financial budget creates a picture of a company's financial health and presents a complete outline of its spending relative to revenues out of core operations. Static budget. A static budget is a fixed budget which stays unchanged irrespective of changes in factors like sales volume and revenue. To exercise control, the budget is usually flexed to reflect the volume that occurred, where it is higher or lower than originally planned. This means that we need to know which revenues and costs are fixed and which are variable.
Uses of budgets. Promote forward thinking, help in liaising the different sides of the business, motivate performance, provide the basis of a control system to provide the system of authorization. Preparing budgets. There is no standard style, and usually budgets are prepared in columnar form with a column for each month. Each budget must link with others. The first step in preparing a budget is to identify the limiting factors. This will determine the overall level of activity. Controlling through budgets. Control is achieved through a comparison of budget performance and actual performance. Variances as increase or decreases in profit relevant to the budgeted profit, which resulted from some aspects of the business activities when taken alone. Budget profit plus all favorable variances less all adverse variances equals actual profit.
Capital spending. Any business in the world requires spending in order to generate revenue, and this spending is represented in the shape of cost and stands as fundamental element of any financial statement. And while normal expense or revenue costs are required to generate the revenue are directly incurred and recorded in the income statement during the same year, yet the accountants are anxious to distinguish between them and the capital expenditures, the CapEx. and these capex represent an investment which will last for years ahead and will be recorded in the balance sheet as an asset. And they usually are in the shape of machines, vehicles, plants, properties, and will be depreciated over years. So why it is important to distinguish between the two types of costs? In addition to the commitment to the international standards and audit requirements, it is important to know that the profit represented at the end of the income statement doesn't mean that the organization is doing well, because some revenue costs might be recorded as a capital expenditure and accordingly not recorded in the income statement. This will amplify the profit and give wrong idea about the organization's status. However, going further in this aspect, the good understanding of the capital spending can be beneficial for the future career in many important roles. So as an accountant, it is very important to make sure that the financial statements are prepared as per the required standards and reflect the correct snapshot of the organization's financial position. However, as a financial or management analysis, it is important to observe the reason behind this spending. In other words, is it about expanding the business or it is just a replacement for a depreciated asset? For example, in case of sales volumes are same or declining despite there is unjustified capex, that means there is a failure in the production process, and this failure can vary from management issue to costing problem. Finally, as a shareholder, understanding the capital spending will give a realistic insight into the profit and cash flow analysis, which means the profit number at the bottom of the income statement will not be by any means the indicator of the organization performance. Hence, as a shareholder who is entitled for dividends, it is crucial to maintain and expand this source of profit.
Funding. Funding can be from personal resources of the company, internal funding. But when the company needs huge money and only internal sources are not enough, they go out and take loans from banks or other financial institutions. That is used when funds are insufficient to clear all debts or a solvent liquidation to extract the capital gain tax-free. Internal funding is when a company sources the funding from its own, for example, from its assets, retained or working capital management. The company needs to fund the business if it has a big leverage ratio. The profit retained is the main source to fund the company. The retained of shareholders, some or the entire dividend they have received. It is low in price and flexible. The working capital management. It is another option of generating cash by reducing the inventory levels that will speed up the customer's bill and tighten the credit control, and that will lead to the customers pay their bills faster. It is the difference between the current assets and the current liabilities. It is the periodic cash needed for the operations to run the business. Working capital management is a process of managing short-term assets and liabilities. It makes sure that a company has enough liquidity to run its operations smoothly. The sale of unnecessary assets. Funds could rise in by trade extra assets, where a business asset sale means the sale of some or all of the company's assets. That may include fixed assets such as machines, land, and buildings, trading stocks, and intangible assets such as intellectual property, patents, trademarks, and goodwill. External sources of funding. It can be defined as any source of finance which comes from outside the business. It can be in the form of equity financing, debt financing, bonds, and debentures. Equity financing. The firm raises capital by selling its shares to the investors, either by an offering to existing shareholders or a placing on a stock market. Equity financing has the potential to bring in far more cash than debt alone. Flexibility in distribution is another advantage to using equity. On the other hand, when investors get some of the ownership of the company, they may interfere in the decision making, and in addition, shareholders get dividend from the company, which may return to be more costly than debt payment. Debt financing. Debt financing occurs when a firm raises money for working capital from institutional investors or individuals with a promise that the principal and interest on the debt will be repaid. Debt financing owners keep full ownership of the business. Moreover, the interest paid on the loan can be tax deductible. But there are many risks associated with this mode of finance. The lenders get paid over the principal amount, which can lead to cash flow issues. In addition, due to the collateral need, that may lead to the seize of an asset in case of default.
Alternative forms of debt are bonds or debenture. A bond is typically a loan that is secured by a specific physical asset. Debenture is secured only by the issuer's promise to pay the interest and loan principal. So, there are a number of factors which influence the owner's decision, which determine the source of fund to be chosen. Such factors include a time period for which funds are required, the purpose of raising finance, and the total funds required by the firm.
Managing financial risks. Businesses face a big number of risks constantly, and in order to avoid them, a whole range of precautionary measurements needs to be taken to protect the business. The major financial risks can be explained as follows. First, strategic risk. This occurs when businesses come up with an incompetent business plan that is hard to be understood or implement. Without having proper and full understanding of the business plan's problems, the normal outcome would be failure. Consequently, designing services and products based on a faulty plan will consume the business's budget as well as its physical and non-physical resources. It is recommended that the management spend proper time and efforts to formulate a strong business plan and not to rush to implementation or production before assessing the success of the plan. Second, market risk. As businesses operate within both local and global markets, any changes that occur externally will lead to internal problems for the business operation and financial performances. The directors here are recommended to analyze the political, economical, social, technological, and legal changes and to be proactive and ready with a backup plan for turning around. Third, the credit risk. Absence of having the enough funds to run operations push businesses to borrow money from the banks. Unfortunately, the granted loans come with a high interest rate and strong guarantee requirements to secure the payment in the future. Failure to do the payment will create legal consequences. As a result, the key here is not to borrow any unneeded money and find other way of funding with lower complications. Fourth, liquidity risk. The liquidity issue occurs when businesses face difficulties in liquidating their tangible assets easily into cash without losing the money value of the assets. A solution is to diversify the investment portfolios, will enable businesses to have better financial returns and revenues. This will prevent them from liquidity risk. Fifth, operational risk. Operational risks such as fraud, theft, damages occur when the internal control process of a business is very weak that will allow employees, suppliers, and contractors to commit mistakes that would endanger the business. As a result, rectifying those mistakes will put the business at risk and will lead to financial waste. Solution: the directors must ensure that all employees are fully aware about the corporate's values and objectives that requires a high level of quality and excellence in the products and services that they are offering. Also, to appoint quality assurance team that will track all the records to prevent any errors or to tackle them immediately before it turns into a habit. The board of directors is the sole responsible for protecting the business from any risks that might lead ultimately to a bigger risk, which is the reputation damage by following the below steps. First, identifying the causes that could lead to the financial risks. Second, measure the money, time, and efforts that will be spent to tackle those risks. Third, monitor if the causes of the risks are the same or changing over time. Finally, if the risk occurred, how can it be mitigated in a very short period of time?